Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. If you have questions or topics you wish to discuss, please chat those over. We're here today to discuss Catch Up Your Retirement, the Greypreneur's Solo 401k Advantage. The presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So let's give a quick overview of what we're here to discuss. We're focused on the concept or the phenomenon of a greypreneur. In other words, someone that's older, but that is still pursuing self-employment activity. It could be a micro business. The problem is catching up on retirement savings after a late career transition, right? Someone might have left corporate America to maybe start their own micro business, but they may be behind on their retirement savings goal. So it's the solution that we want to discuss, or at least the potential solution, is a solo 401k as a powerful tool to catch up on those retirement savings. So let's dive in and discuss how the solo 401k can act as a superpower in that situation. And it stems from the fact that the solo 401k has the highest contribution limit for any defined contribution plan available to self-employed individuals. And that's because, in the words of the IRS, the greypreneur is both the employee and the employer. So they're able to make both types of contributions, fill up both buckets. And that's how you're able to, as I mentioned, have the highest contribution limit for any defined contribution plan available to self-employed individuals. And for someone, of course, that fits this profile as a greypreneur, they're also therefore going to be eligible to make catch-up contributions. So if you look at each bucket, the first bucket for 2025, the contribution limit is $23,500. The catch-up contribution bucket would allow someone to contribute an additional $7,500 if they're 50 or older for 2025. Now, with 2025, there is a new catch-up bucket for those aged 60 to 63, often referred to as a super catch-up contribution, where instead of making $7,500 as an additional catch-up contribution, that individual that's age 60 to 63 could make an $11,250 contribution instead. And this all presupposes that the individual has the earned self-employment income to justify the contribution. It also presupposes that they're not making contributions to another plan like a day job plan. But if that is the case, if they have the earned income to justify the contribution and they're not making contributions to another plan and they're eligible to set up a solo 401k because they're self-employed with no non-owner, non-spouse, full-time W-2 employees, then that individual could fill up that employee bucket as well as those catch-up contribution amounts on top of that. Now, that's not the end of the story because I mentioned that's just the employee side. In the words of the IRS, when you're self-employed, you're also your own employer. So that means that you can also make employer, what they call profit sharing contributions to the solo 401k. Now, the profit sharing contribution limit is a percentage of your self-employment compensation. And the percentage that applies will depend on how the self-employed business is taxed. So for example, for someone whose self-employed business is taxed as a sole proprietorship, it could be a single member LLC that's a disregarded entity where the income is reported on Schedule C of the 1040. In that scenario, you need to run a pre-calculation, which we do help our customers determine this pre-calculation amount as part of our service every day. We've also got a calculator on our website that'll help you run the numbers. But in short, the pre-calculation entails taking your earned net self-employment income, specifically what's reported on line 31 of Schedule C, less 1/2 of the self-employment tax. That is considered to be your self-employment compensation. The product of that pre-calculation is the amount upon which you determine how much you can contribute. So for example, you could contribute 100% of that amount, dollar for dollar, up to $23,500 plus an additional catch-up, depending on your age, as an employee contribution. When it comes to employer contributions, though, if your business is taxed as a sole proprietorship, the employer contribution limit is 20% of that figure, 20% of the amount equal to line 31 of Schedule C, less 1/2 of the self-employment tax. Now, if on the other hand, your business is taxed as an S Corp or a C Corp, your ability to contribute to the solo 401k is based off of the W-2 wages that you receive from your self-employed business taxed as an S Corp or a C Corp. Specifically, you would take box 1 of the W-2 plus any pre-tax elective deferrals not in box 1, but instead reported over in box 12. So of that amount, you can contribute 25% as an employer contribution. Now, keep in mind, you still have the overall limit, right? So the sum of employee, employer, plus any voluntary after-tax cannot exceed the lesser of your self-employment compensation or the overall limit. So that takes us to the voluntary after-tax, which is how one makes mega backdoor Roth contributions, which is one of the most common reasons that clients will set up accounts with us, because our plan, of course, allows for those mega backdoor Roth contributions. And we have tremendous experience and provide tremendous support in helping customers accomplish and make that mega backdoor Roth contribution. Now, the way that you make a mega backdoor Roth contribution is really by making what's referred to as a voluntary after-tax contribution. So the voluntary after-tax contribution limit is 100%. So it's not a percentage like the employer contribution limit. It's 100% dollar for dollar of your self-employment compensation, whether that's W-2 wages, for example, in the case of a business tax as an S Corp, or whether that's the product of that pre-calculation, for example, line 31 of Schedule C less 1/2 of the self-employment tax, if your business is taxed as a sole prop or a disregarded entity, maybe a single member LLC. But you can contribute 100% dollar for dollar up of that amount up to $70,000 for 2025 as a voluntary after-tax contribution. Now, of course, you still have to consider the overall limit, right? So the sum of your employee, employer, plus any voluntary after-tax contributions that you make cannot exceed the overall limit. And the way that you make a mega backdoor Roth contribution is really a two-step process, because you first have to deposit the voluntary after-tax contributions into a separate voluntary after-tax account before they're moved over to either the Roth solo 401k or a Roth IRA, so you can have that tax-free growth, at least that potential for tax-free growth. Now, your overall limit for 2025 is $70,000, but it goes up if you're 50 or older. It goes because of the catch-up contribution. So the catch-up contribution doesn't count towards the $70,000 overall limit. So that means effectively you could potentially contribute up to $77,500 if you're 50 or older, or $81,250 if you're age 60 to 63. So this is why the solo 401k is so powerful, right? If you compare it, for example, to an IRA, you're looking at 10 times potentially the amount of contributions that you would typically be able to make to an IRA. So that could really help solve the problem that we're talking about here, which is that of a greypreneur who's still working, maybe now pursuing their self-employment activity, but maybe behind on their retirement savings goal. Now, for some, they really want to focus on Roth contributions because they want to have that potential for tax-free growth. And again, that's one of the top reasons that customers will set up accounts with us. So that's where you need to have a plan like ours that allows for those mega backdoor Roth contributions. And then it's going to make sense to work with a provider like my solo 401k Financial, like us, that has tremendous experience, provides tremendous support in helping clients through that specific process. Because as I mentioned, it's a two-step process. You first need to deposit into a separate voluntary after-tax account, which we help our customers open up accounts at the bank or brokerage of choice. So maybe a separate voluntary after-tax brokerage account at Fidelity before their funds are moved over to, say, a Roth solo 401k or Roth IRA. Now, that first step, the after-tax contribution, that's not reportable on the personal or business tax return. It doesn't need to be reported. But the second step, when you move the money from the after-tax account to the Roth account, whether it's going to a Roth solo 401k or a Roth IRA, that is reportable on a Form 1099-R. And we handle that as an optional free service for our customers. Customers just have to complete our online form to give us the information we need. Then we add the plan to the queue and we prepare that 1099-R for no additional charge. So it's an optional free service. Now, other top uses when it comes to our plan And this is why it really has been ultimate type of solo 401k in the sense that it's got all the features. You can also invest in alternative investments. Some individuals may have experience maybe in real estate. Maybe they're a realtor and they're more comfortable with investing in real estate as opposed to the stock market. Of course, you can invest in the stock market. As I mentioned, Fidelity is one of the top options. Schwab is also a very popular option where we help customers open up a free brokerage account where they can invest in your typical brokerage type investments, whether that's stocks, bonds, mutual funds. But because the account is governed by our IRS approved plan documents, which does allow for alternative investments, whether it's real estate, private equity, lending, cryptocurrency, you can also invest in those types of investments as well. So some individuals, for using the example here on the screen, they might be buying property with their plan, using their solo 401k funds. The property's held in the name of the solo 401k. Maybe it's a rental property. So all the income and expenses goes in and out of that solo 401k account where the income can grow and potentially tax-free if they acquired that property with raw solo 401k funds. So practical steps, just to continue to paint the picture, is if someone is self-employed, right? Let's assume they're this Greypreneur who now has left their corporate job. They have their own self-employed business, no employees working for any business owned by them or a spouse, if any. They're eligible therefore to set up a solo 401k. So a solo 401k is really a legal entity. It's a retirement trust. So like any legal entity, it's the documents that create it. So they're opening up the plan with us, meaning the documents, but then using those documents to open up an account at the bank or brokerage of choice. So we've helped customers open up accounts at hundreds of different banks, credit unions, as well as brokerages like Fidelity and Schwab, just to give a couple of the more popular examples. They might want to maybe take a loan, right? They could use the loan to grow their business. They could use the loan for really any purpose, right? Maybe they want to remodel their home, whatever the case may be. They're totally free to use the proceeds of that loan for any purpose whatsoever. So that's another popular feature where you need to have a plan like ours that allows you to take a loan. And then you have to go through the required steps. Because when someone withdraws the money from their solo 401k as a loan, it's not going to be subject to taxes or penalties as long as it's, number one, documented as a loan, which we handle the required loan documents as part of our service for no additional charge, and then paid back according to the terms of that loan. So it's going to be paid back. It's going to need to be paid back either monthly or quarterly. It's up to you. Equal payments of principal and interest. The interest is going to be prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. So we give the example of a consultant who needs to borrow funds for their business, or maybe they need to pay out a loan. But at the end of the day, they're not taking the loan from a bank, right? So there's no credit check. They're not paying it back to a third party like a bank. They're essentially borrowing it from themselves and paying it back to themselves. And then lastly, we just want to highlight the tax credits. So our plan will make the self-employed business eligible to claim $1,500 in tax credits, $500 per year for 3 consecutive years, which is tremendous, is helping to offset, for example, the cost. That's going to more than cover our fees for the first 7 years. All right. Well, that takes us to the end of the slides that we wanted to share. Hopefully that was helpful to just shine a light on a growing segment of the self-employed universe. There are, of course, a growing number of self-employed individuals, solopreneurs. So if you're finding this to be helpful, if you could please like this video, share it with others. It helps us to get the word out to others that might find this information to be very useful in helping to secure their retirement. We'd really appreciate that. If you do have questions, don't hesitate to chat it over. We'll give it a moment to see if any questions come through. In the meantime, yes, please subscribe to our channel. We go live every day, whether on Instagram or LinkedIn or X. So if you subscribe, YouTube, of course, you'll get notifications of when we go live. And then you can jump on and hear what we're wanting to share every day, or come and ask questions, maybe see what other folks are asking. We also invite you to our community. We have the largest community of self-directed investors, over 30,000 members in our community. So that means we've got a lot of forums that are active forums. We have a library of videos and webinars. So there's a lot of great ways to learn and to share the knowledge. Yes, we are live here. So please chat over your question. Try to pull up your account while you're doing that. It sounds like your former employer is understanding. I'm seeing this support inquiry from about an hour ago. It sounds like your former employer may be understanding that you are. Oh, I see. They want to put the FBO language. So they got the name of your plan, FBO. That's fine. Whatever they put after the FBO is acceptable. Ultimately, the key is that they understand that you are transferring the money to your new employer plan, because they're going to need to report the transfer to the IRS. And so it's going to be important that they understand that you've documented, right, that you have directed them to transfer it to your new employer plan, because that is reportable when money leaves the retirement account. But you want to make sure that they report it to the IRS as a non-taxable direct rollover. And then what's going to happen is they're going to mail the check to you, to the address of record. And then in the meantime, you would be opening up an account. Could be at a bank, could be at a brokerage. Once you receive that account, you then want to deposit once you receive that check, you then want to deposit the check into the applicable account. So if it's all pre-tax money that's coming from your former employer plan, deposit it into the pre-tax account that you have for the solo 401k. Yeah, that's fine if you put the account number on the check. I mean, ultimately, it's just going to be a check, and you're going to give it to the bank or the brokerage and direct them to deposit that into the bank or brokerage account for the solo 401k. So if you're opening up a bank account, I can see that we sent you the packet a day or so ago. So what you want to do is set up an appointment with your banker. Most clients find that local banks and credit unions work best. Forward the packet to them. And now it's going to be important to use language that the bank understands. So remember, a solo 401k is a trust. It's a retirement trust. And you are the trustee of the trust. So what you're explaining to the banker is and using the language that the bank understands is that you are the trustee of a trust. You have an EIN number for the trust, and you're looking to just open up a bank account for the trust. As opposed to, for example, saying that you're trying to open up an account for a 401k to maybe invest in real estate, because that's going to really take the conversation sideways. They may get their IRA department involved. And obviously, you're not opening up an IRA. You have a 401k, which is a different type of account. And you're just looking to open up the account for that trust. Hopefully that makes sense. Please don't hesitate to reach back out. Or if you have more questions now. Yeah, we'll forward you the packet. Okay, that should be on its way here in a second. Thanks so much for your business, and thank you for your good questions. All right, so next one. I just opened a Fidelity account for my solo 401k. I'm using an account for pre-tax, which appears to be the after-tax account. Is this okay if I'm consistent? Yeah, so if you are opening up multiple accounts, thank you so much. If you're opening up multiple accounts at Fidelity, remember Fidelity is just providing the account for a third-party plan. So the key is that the accounts are used consistently. For example, one for pre-tax, a second for Roth, a third for after-tax. What is in Fidelity's records is not determinative because they're just providing the account. The key is that you're using it consistently. And if there's multiple participants, that each participant has separate accounts. Now, what can often be helpful is to nickname the accounts. So we'll send you a short guide about how to nickname the accounts at Fidelity. But you can go in there and just basically log in and change the name. That way that helps you keep track of which account is which. And the key is ultimately just using them consistently. Hopefully that makes sense. Thank you for the good question. So if there's other questions, please don't hesitate to chat it over. We appreciate your good participation today. Again, if you're finding this to be helpful, please like, please subscribe as we go live every day. Please share with others that might find it to be helpful. All right, that should be on its way as well. All right, let's see if there's any more questions. 1 second here. Okay, I've deposited my check. How do I convert it to Roth and Fidelity? Thank you for your previous answer. So once the funds clear, you're going to want to just log in to Fidelity, or if you call the number of the team at Fidelity that supports these accounts, and then they, based on experience and feedback, they can help you move the money that you want to convert from the pre-tax solo 401k account to the Roth solo 401k account. Now that is going to be taxable as well as reportable, because you are moving money from a pre-tax status to a Roth status. So we prepare the required tax form to report that as an optional free service for our customers. You would just need to give us the information we need in a timely fashion. So after we're done here, we'll shoot you the link or a link to the page on our website that customers use to give us the information we need to prepare that 1099-R. Let me just make a note of that so we do that after we hang up. Good question. All right. Okay, you got the email from the junk. Awesome. Yes, it's possible to move it in kind. Now it's going to be when you're completing the online form to tell us the information needed, because that's going to be taxable when you move it from the pre-tax status to the Roth status. You want to use the amount, the value of those investments when they move into the Roth account, when you're completing the online form to give us the information we need. And then that's going to be the amount that's taxable. All right, let's see. That might be the end of the questions for today. Great participation, though. We really appreciate it. All right. Well, until next time, everyone, take care. Please check your email for that second follow-up email.